Meet Mike, a guy with a dream of building his perfect home for his family. Unfortunately, his bank account doesn't quite match his ambitions. What can he do to make it happen? Well, he could hit up his friends for a loan, sell off some of his stuff, or choose the traditional route and get a bank loan. After weighing the pros and cons, Mike decides to opt for a bank loan and voila, his dream home becomes a reality. Now, let's shift our focus to Uncle Sam, also called the US government. They are in a similar situation, wanting to build infrastructure like roads and railways, but lacking the necessary funds. Banks might not be able to provide what they need, and asking citizens to lend money could send the wrong message. So, what's the solution? Treasury Securities in the form of bills, notes, and bonds come to the rescue, providing the necessary funds for government to spend money on its operations. Here is how Treasury Securities work. Let's assume the government needs $50 billion for its operations. The government will issue bonds worth $20 billion with a maturity of 20 to 10 years. It will issue Treasury Notes worth $20 billion with a maturity of 1 to 2 years. And lastly, it will issue Treasury Bills worth $10 billion with a maturity of 4 weeks to 1 year. Let's now dig deeper into Treasury Bills, Notes, and Bonds, along with their risks and benefits. Treasury Bills, also known as T-bills. These are short-term securities with a maturity of 1 year or less. They are issued at a discount to their face value, meaning that investors pay less than the face value of the bill. Let's say John wants to buy Treasury bills set for rate 1% for $1,000 with a maturity date of 4 weeks. The government issue this bill for $990 and not $1,000. At the end of 4 weeks, Mike will receive the full face value of $1,000, which represents the original loan amount plus the 1% interest. In this example, Mike would earn $10, which is 1% of $1,000 over a period of 4 weeks. Next up, we have Treasury Notes. These are medium-term securities with a maturity of 2 to 10 years. Like T-bills, they are also issued at a discount to their face value, and investors receive the full face value when the note matures. However, unlike T-bills, Treasury Notes pay interest to investors twice a year, based on a fixed coupon rate. Let's say Sarah wants to buy Treasury Notes for $10,000, which would mature in 5 years at 2% interest. The government would issue a $10,000 bond at a face value of $9,800. Sarah would then receive every 6 months, semi-annual interest of 2%, which is $100. At the end of the 5-year maturity period, the Sarah will receive the full face value of $10,000, which represents the original loan amount. In this example, the Sarah would earn $1,000 in interest over the 5-year period. Finally, we have Treasury Bonds. These are long-term securities with a maturity of more than 10 years. They are also issued at a discount to their face value, and investors receive the full face value when the bond matures. Like Treasury Notes, Treasury Bonds also pay interest to investors twice a year, based on a fixed coupon rate. Priyanka wants to invest $100,000 in a relatively safe and stable investment option. After researching different options, she decides to invest in a 10-year Treasury bond with a face value of $100,000 and an interest rate of 2.5%. Priyanka purchases the bond for $95,000, which is less than its face value. Over the next 10 years, Priyanka will receive semi-annual interest payments of 2.5% of the face value, or $1,250 every 6 months. At the end of the 10-year maturity period, she will receive the full face value of $100,000, which represents the original loan amount. Priyanka would earn $25,000 in interest over the 10-year period, in addition to the return of her original investment. Thanks for watching. Don't forget to subscribe to the channel. Come back soon for more productivity videos.